Kia ora, and welcome to the CoreLogic Property Market Update for Whiringa Anuku, October 2023. Brought to you by Loan Market. As we wait for the dust to settle from the general election, and as the formation of our government and any coalition deal takes shape, it's a good time to draw a line in the sand for our property market. This is also timely, considering we're at a turning point for value change, with the CoreLogic House Price Index tracking sideways in September, 0.0% movement over the month. This caps the peak to trough fall at 13.2%, still 24.3% or $177,000 higher than pre-COVID. Beneath a nationwide measure, we're seeing pockets of growth emerge, and not just on the latest monthly measure, but some over the longer 3-month period too. The 3-month growth rate ranges from 0.2% in Ōtautahi, Christchurch, right through to 4.2% in Papakura. Meanwhile, in a trend that will likely define this inflection point of the market, we're also seeing values continue to fall in some markets. Inconsistency will likely remain a feature for a while. Tahuna, Queenstown, which previously looked relatively immune to value falls, has now decreased by 2.8% since July. Tamaki Makaurau, or the Old Auckland City, generally defined as the Isthmus of Auckland, also fell by more than 2% in the last 3 months, as did Rotorua, while Kirikiriroa Hamilton values fell by 2.0%. The list of locations which fell by more than 1% is relatively broad, spanning the country from Whangārei to Te Awa Kairangi Tai, Lower Hutt, and from Tauranga to Ngā Motu, New Plymouth, and Te Ika a Maui, the North Island, and from Whakatu, Nelson, to Ōtepoti, Dunedin, and Te Waipounamu, the South Island. In terms of assessing the scale of the downturn, there is similar variability in the growth outcomes across the country. The percentage fall from the peak of the market ranges from about 3 to 6% in Tahuna, Queenstown, Waihopai, Invercargill, Ngā Motu, New Plymouth, and Ōtautahi, Christchurch, all the way up to a range of roughly 17 to 22% in Ahuriri, Napier, the Auckland Super City, the Kapiti Coast, and the wider Wellington area. Further historical context, accounting for the large upswing in values through COVID, may also better illustrate the state of each market across the country. Te Awa Kairangi Tai, Lower Hutt values are now only 11.9% above pre-COVID, and Ōtepoti Dunedin only 13.5% higher. Meanwhile, Ōtautahi Christchurch sits 42.6% above March 2020, and Whanganui 39.9% higher. In terms of prospects for the broader market, affordability, impacted crucially by interest rates among already high house prices, is likely to continue to constrain demand as we move through the next phase of the cycle. Those high interest rates are also still flowing through to homeowners' mortgage payments too, with September and October seeing an increasing volume of debt due for renewal. While we should acknowledge we're through the worst of the interest rate increases, and seemingly without too many problems hitting mortgage holders, a healthy respect for further difficulties to come is prudent. This is especially true with one more OCR decision to come from the Reserve Bank, though there's a bit of time, data and information to come before we truly contemplate what could be in store from the last monetary policy statement of the year. More immediately, property enthusiasts will be keenly awaiting confirmation of any government coalition negotiations and concessions. On the face of it, it appears quite likely we'll see a shortening of the capital gains tax Brightline test, back to 2 years, and the phased reintroduction of interest cost deductibility, which will both be welcomed by current and future property investors. Investors who, as a group, have been quieter recently, have been impacted by reduced profitability, not all of which will be relieved by the proposed changes. High prices, alongside high interest rates and already squeezed rental prices, are seeing yields remain constrained. And while the national election victory will improve the sentiment for property investment, we don't expect the market to suddenly take off due to those affordability constraints. Add in the likely introduction of debt-to-income restrictions early next year, which will further cap the ability to grow investment portfolios, and future capital growth still seems likely to be lower than what we've seen in the past. First home buyers, on the other hand, have been enjoying the quieter market, picking up a record 27% of sales in September, and perhaps many of them anticipated stronger competition on the horizon, which could now limit their success. They've proved a resilient bunch though. There's plenty of data to watch for over the coming month, so make sure you stay across it all by following our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X, formerly Twitter, or Facebook. Download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.